China's economic signals rarely come through headlines. They come through policy moves, quiet, calculated, and deeply intentional. And on May 8, 2025, one of those signals was sent when the People's Bank of China cut its key 7-day reverse repo rate from 1.50% to 1.40%. At first glance, this might look like a routine monetary move, but timing, context, and composition tell us something else. China is preparing its economy for continued external volatility, especially from ongoing U.S. tariff pressure, while reinforcing internal liquidity to keep its growth engine stable. This isn't just stimulus, it's signaling, and understanding this signal matters if you're anywhere near cross-border business, capital advisory, or regional trade, especially if you're in Singapore. Let's break this down. First, what is the 7-day reverse repo rate? In simple terms, it's the interest rate at which China's central bank lends short-term money to commercial banks. It directly influences liquidity in the banking system and acts as a key lever to encourage or discourage lending activity. Unlike the U.S. Fed, which uses the federal funds rate as its primary benchmark, China leans on tools like the reverse repo to guide interbank funding costs, market sentiment, and policy tone, all without major press conferences or disruptive announcements. This is the second cut in under a year. Back in September 2024, the People's Bank of China reduced the same rate by 20 basis points. May's 10 basis point reduction reinforces a pattern: gradual, cautious easing, not a fire hose of liquidity, but a steady drip. And why now? The U.S.-China trade relationship is once again unstable. Tariffs have been ratcheted up, supply chains are in flux, and foreign direct investment into China is under tighter scrutiny. These macro forces could spook markets or slow expansion unless China makes a proactive move to keep capital flowing. That's where this cut comes in. It sends a clear message to the domestic market: we've got your back. Banks can access cheaper capital. Borrowing conditions ease, local governments have more maneuverability, and businesses feel less pressure to pull back investment. But there's also an external message being sent quietly to global investors, ASEAN trade partners, and even the United States. It says, while you're escalating tension, we're lowering volatility. That contrast matters more than most realize. Now let's talk positioning. For Singapore-based professionals, whether in law, finance, compliance, or logistics, this moment opens a specific kind of opportunity. Not because you're trading bonds, but because rate cuts often precede deal flow. When monetary easing begins, it lowers the friction of expansion. It smooths out the cost curve for entering or expanding in China. It encourages local partners to co-invest. It reduces risk perception, and it allows for more flexible financing structures. That's where back-end players come in. If you're helping clients structure market entries into China, or navigating cross-border payments, or facilitating capital movement into ASEAN-China corridors, this is the moment where policy opens doors faster than politics can close them. Let's go deeper. The current cut also aligns with China's push to stabilize the yuan. While some countries respond to U.S. trade aggression by devaluing currency in big steps, China has taken a steadier path. The People's Bank of China has been careful to signal stability, both in its FX band and in its short-term rates. That matters for international confidence, especially in the context of Belt and Road settlements, RMB-denominated contracts, and regional liquidity frameworks. Here's how it plays out for dealmakers in Singapore. Let's say a client is considering expanding manufacturing capabilities into southern China, maybe to take advantage of new regional incentive programs in Suzhou or Chengdu. A more accommodative rate environment gives that client better leverage with local financing partners. It gives lenders confidence, and it gives you, the strategist or advisor, more tools to work with. Or maybe you're advising a fintech client setting up RMB payment rails across ASEAN. Lower repo rates signal that China wants smoother liquidity flow, meaning regulators, banks, and compliance officers will likely be more cooperative in enabling new architecture. These are not just abstract moves, they translate into softer doors, better margins, and faster turnaround, but only if you're paying attention to the right signals. The media may focus on whether the US and China will sit down at the table. That's noise. This rate policy is structure. And structure is what real operators work with. So, how should Singapore respond? First, recognize that while Singapore may not control the narrative, it can control the infrastructure. That means we can be the back end for RMB-friendly platforms. We can be the legal jurisdiction for cross-border contracts. We can be the trust layer in capital flows that touch both Chinese institutions and ASEAN operators. Second, educate clients fast. Most businesses in the region are still reactive, watching global news but missing local levers. The firms that help them understand China's internal moves will be the firms they rely on when it's time to act. Third, move with urgency but precision. This rate cut is not a forever window, it's a momentum nudge. The longer you wait to build, the more crowded the back end will get. Legal firms will start productizing market entry advisory. Fintechs will specialize in RMB trade facilitation. Logistics networks will evolve into regulatory integrators. There is room now, but not for long. So, what's the bigger picture? This move tells us that China is not waiting for the world to calm down. It's engineering its own calm, through liquidity, not diplomacy. It's using money supply to dampen volatility, build confidence, and power selective growth in strategic sectors. That's not weakness, that's sovereignty. And if you're reading this right, you understand the shift already started. The central bank just confirmed it. If you've been watching headlines, now is the time to dig deeper. If you've been waiting to step into cross-border strategy, now is the time to build. And if you want to stay informed not by noise but by signal, we've built a private Telegram group for that exact purpose. Drop a comment with IN if you'd like to join and receive verified updates daily, the ones that don't make the headlines but move the real deals. Stay sharp.